In this video, I'm going to go over the 5 things that impacts your credit score the most. And stay tuned for the 5th tip because there is so many myths surrounding this factor that goes into your credit score. It's unbelievable, so you don't want to miss that. But before we get into it, please hit that like and subscribe button. It allows other people to find this content too. So if you're liking what I'm putting out there, hit that like and subscribe. Thank you. Okay, so let's dive in. Before I get to those 5 tips, we need to understand, first of all, what a credit score actually is and why it's so important to have a good credit to begin with. Let's review. Credit score is basically a summary of how you pay your bills, your credit cards, your car loans, your lines of credit. Anything that you've applied for credit for typically reports to your credit bureau. And there's 2 credit reporting agencies in Canada. We have Equifax and TransUnion. The majority of banks and lenders look at Equifax reports, and there's a few others that will consider TransUnion, and there's even a few that will look at both. So it's important to review Equifax and TransUnion credit reports. And within that credit report, it will come up with what's called a FICO score. And this can be as low as 300, which is not so good, up to as high as 900, and we call those 900 scores unicorns because we don't see them very often. Obviously, the higher your credit score, the more likely you're going to get approved for the financing you're looking for, the more likely you'll receive favorable interest rates. So, what makes up that credit score? I'm going to talk about the 5 most important things that goes into making up that credit score. So, number 1, the number 1 thing that impacts your credit score the most, payment history. So what do I mean by payment history? You apply for a credit card. Every month you're going to get a statement, and it's going to have a minimum amount due. If you do not make that minimum payment, it means that you are 30 days behind on your credit card bill. Or if you've missed a car loan payment, it means you've fallen behind on your car loan payment. This is one of the biggest factors that brings people's credit scores down the most. When you start missing payments, scores are going to go down because it's a predictive indicator that if you were to apply for a mortgage, there's a likelihood you may miss those mortgage payments too if you can't keep up with your current credit card payments or car loan payments. And it's so frustrating to see when people have small balances owing and they have small minimum payments of $10, $15, $20, and those payments don't get made. So it's so important to keep an eye out on what your minimum payment is, guys, and make those payments without fail. Do not miss those payments because that is the most important piece of your credit score. Number 2 is utilization. So what does utilization mean? It's pretty simple. If you have a credit card for $10,000 and you owe $10,000, you're maxed out. You are 100% utilizing all of your available credit. You have nowhere else to go. So this is also an indicator that you borrow but are unable to pay back. You might be able to make the minimum payments, but your utilization is at 100%. So that's not good. That's going to bring your score down. But this is also one of the easiest things to help you fix your credit score, to get a short-term bump in the score if you need it. A couple of ways we can do that is if your credit score is still good, you might actually be pre-approved or pre-qualified for a higher limit. So if you owe $10,000 and your limit's $10,000, but the credit card company says we can give you $20,000. If you take that, now you've gone from 100% utilization to 50%. Your score will increase because of that, but it's also important not to use that new credit they just gave you. Otherwise, your score is going to go down again. Other ways we can improve your score due to utilization is simply if you have room on a line of credit, we transfer balances to a line of credit. So if you owe $10,000 on a credit card and the limit's $10,000, but you have room on your line of credit, move that $10,000 over to the line of credit. And now the utilization has dropped on that credit card, your score will increase. Now, that's not ideal because anytime you're doing balance transfers, there's typically a 2 or 3% balance transfer fee. So if you do that consistently over the months, it's going to add up pretty quickly. So this is just like a one-time shot, just to improve that credit score a little bit if you need it. Okay. Other ways to bump those balances down is if you already own a house, there's options available to get a short-term second mortgage. It doesn't show up on the credit report. Pay off those credit cards, score shoots up, and then refinance if that's what your intended plan is. Okay. The third factor that goes into credit reports is the length of time you've had your credit for. So if you have a $1,000 credit card that you got last month, it's not going to go very far in terms of improving your credit versus if you've had a credit card with TD Bank for $10,000 and you've had it for 15 years and there's never been any missed payments and you're not maxed out on it. That's going to go a lot farther to increasing your score. And our number 4 tip to improving your credit score is you need to have a strong credit mix. So what do I mean by a credit mix? It means you're going to have different types of credit. It's going to be credit cards. You're going to have car loans. Maybe it's a student loan. Maybe it's a line of credit. Maybe it's utility bills or cell phone bills. So you're going to have a variety of credit. It's not all going to be a $500 secured credit card. The lenders want to see that you have multiple different credit options and you're able to pay all of those on time. And our last tip, the final tip, the biggest myth out there about credit scores. And I'm going to blow this myth out of the water, guys. The biggest myth out there is credit inquiries. Now, I don't know how this got out there, but people seem to think they need to hold on to their credit as tight as possible, like it's the caramel secret. And it's not. You want to be able to let people make credit inquiries because the whole point of having good credit is when you need it, when you need to apply for a mortgage or a car loan, you want people to be able to check your credit to confirm that you actually use it and have it and can pay your bills on time. When you're applying for a mortgage, you can actually apply with multiple different lenders in a 45-day window, and it only counts as one credit inquiry. So a lot of people think, no, I'm not applying for, I don't want to apply for a mortgage with more than one lender because it's going to impact my credit. And that's simply not the case. If we see multiple inquiries for different credit, so credit cards, credit lines, unsecured loans, Equifax then views you as a credit seeker, and then there's additional risk for that. So you will see a score drop the more credit inquiries when you're seeking credit cards, unsecured loans, and that sort of thing. But if it's for mortgage financing or for car financing, where they know you're shopping around, if you have multiple credit inquiries, it's not going to impact your score. And if you already have an 850 score and you've got one credit inquiry and the score goes down to 847, it doesn't make a difference. You're still going to get approved for the mortgage at best rates, so you don't need to worry about it. Okay? So let's recap 5 things that impact your credit the most. Number 1, payments. Missed payments counts for about 35% of your overall credit score. Okay? Credit utilization. If you are maxed out, it's going to go against you. That counts for about 30% of your overall credit score. Length of your credit history accounts for about 15% of your overall score. Credit mix, that accounts for about 10% of your overall score. And credit inquiries counts for 10% of your score. So it's very low in the grand scheme of things. I hope this was eye-opening. I hope I shed some light on credit reports and why they're important to have, why it's important to keep an eye on, but also we don't necessarily need to be obsessed over it too. Make your payments, don't max out your credit, and you will be fine. You'll qualify for the best financing possible, whether it's mortgages or cars. If you like this video, please, again, hit that like and subscribe button so other people can follow it. And if you have any questions, put them in the comments below and I will get back to you, and I look forward to making my next video.